The assumption of permanence in investing is just, well, it's fascinating because it directly contradicts how we treat literally almost every other asset we own.
Right. It really does.
I mean, if you buy a physical building, you inherently understand that the roof will eventually leak,
Oh, absolutely.
or
Right.
the HVAC system will eventually fail, or the foundation might settle. Continual maintenance is just completely baked into your mental model of ownership.
Yeah, you expect it. It's a physical thing.
But somehow, when we buy a piece of paper representing a claim on a business or, today, a digital entry in a brokerage account, we convince ourselves we have purchased this finished, immutable product.
Like it's never going to change.
Exactly. We treat it like an engineering marvel. You pour the concrete for a bridge, and you expect it to just stand there for a century.
Right. You don't wake up every morning wondering if the bridge evaporated overnight.
You don't. Yet, when you step into the world of long-term capital allocation, relying on that same expectation of structural permanence becomes incredibly dangerous.
It's a huge trap.
It really is. Questioning the durability of what you own might actually be the single most critical discipline in managing capital over a lifetime. Welcome to Capital Allocation Lab. Please subscribe and like to support more educational episodes. We are thrilled to have you joining us for this analysis.
We really are. And our mission here is always centered on translating these classic investing and economic principles into practical structural judgment.
Which is so needed.
It is. We focus on clear definitions, the actual underlying mechanics of how these concepts function in the real world, and, stripping away all that promotional hype that typically surrounds financial media.
And just to set the table properly before we jump in, this content is purely educational.
Right. Very important.
It should not be construed as individualized investment, legal, tax, or accounting advice. Our goal is to examine the frameworks of thought, not to give you specific recommendations for your portfolio.
Exactly. We're here to do a deep dive into the mechanics of thought, not tell you what to buy on Tuesday.
Right. And today's core focus requires us to really examine a process that almost never makes it onto financial television.
Because it's boring.
It's so unflashy. We are dissecting the calm, serious, and absolutely necessary process of supervising investment holdings.
Supervision. A heavy word.
It carries a specific weight in this context. It's essential to define what we're fundamentally talking about and maybe more importantly, what we are actively avoiding.
Yeah, let's clear that up right away.
This process has zero relationship to day trading. Zero. It is the exact opposite of reacting to macroeconomic news headlines or Federal Reserve press conferences.
Or trying to guess tomorrow's market prices.
Exactly. It's entirely about the mechanics of stewardship. It's addressing the reality of how an owner actively protects their capital after the initial purchase has been made.
And that's where the industry gets it wrong, right? The financial industry focuses this overwhelming amount of energy purely on the buy decision.
Oh, 100%. The screen, the analysis, the transaction itself.
That's where the excitement lives. But the period between buying and selling, which, for a series capital allocator could span multiple decades, that is where the compounding actually happens.
Right.
And consequently, that's where the actual work of wealth preservation has to take place.
So we're looking at the reality that a highly scrutinized, fundamentally sound investment is not something you just acquire and then permanently ignore.
Safe at the moment of purchase does not translate to safe forever.
And for you, the listener, that is a remarkably difficult truth for human psychology to process.
Oh, it's painful.
There is this profound emotional seduction embedded in the concept of the permanent investment. Investors inherently want the psychological relief of finality.
They want to be done.
Yes. If you secure a high-grade bond or acquire a blue-chip stock with a 100-year track record, the goal is to mentally retire that capital.
You want the mental freedom to walk away, focus on your life, your career, and just collect the income without a single moment of anxiety.
And the emotional appeal of that is undeniable. It promises maximum reward for a finite burst of effort.
Right. You do the rigorous work at the start, you evaluate the balance sheet, assess the competitive position, make the allocation.
And then you just expect a lifetime of uninterrupted peace.
You put it in the vault and only check on it when the dividend clears.
Exactly.
Yeah.
And if we examine the logic of this desire, especially with fixed value investments like corporate bonds, the expectation of passivity is actually quite rational.
It makes sense on paper.
It does. The structural bargain of fixed income justifies it. When you buy a bond, your upside is strictly contractually capped.
You are explicitly denied unlimited participation in the company's future growth.
Right. So if the company uses your money to invent a revolutionary technology and their profits explode by 10,000%, your reward does not increase by a single basis point.
You get your stated coupon rate, and at maturity, you get your principal back. That's it.
Your return is structurally constrained. So logically, you deduce that if the reward is limited, the operational trouble and emotional burden should also be strictly limited.
That is the precise contrast between equity and fixed value ownership right there.
Yeah.
An equity investor buys a proportional share of the business, so their theoretical upside is infinite.
Because they capture the total economic surplus.
Exactly. And because of that, they implicitly accept the complexity, the volatility, the need for ongoing vigilance.
But the fixed income investor is entering a fundamentally different contract.
Right. They trade away the potential for unlimited wealth creation purely for stability and priority of claim.
So they rightfully feel that a constrained return demands constrained effort.
But here's the underlying flaw. While the logic is totally sound, the historical reality of the capital markets just completely refuses to honor that agreement.
Market history does not care about your desire for a low-maintenance asset.
It really doesn't.
Investors have discovered through market cycles and agonizing impairments of capital that securities considered safe beyond any need for examination can still fundamentally disintegrate.
And the shock isn't usually that the quoted price fluctuates. People expect some volatility.
Right. Prices go up and down.
The profound shock is when the underlying economic engine supporting the security systematically decays. The facts on the ground actually change.
And that decay brings us to a principle that you just have to permanently etch into your mind. Reputation is not supervision.
Oh, that's such a critical distinction. A reputation is merely a historical snapshot.
It's a label.
It's a label assigned by a rating agency or just collective market consensus at a specific moment in time.
So a security might carry the label of high grade or belong to a company with a flawless track record of dividends for 50 years.
But that label possesses absolutely zero structural power to freeze the current business reality in place.
High grade is not a magical force field.
No, it's not.
While you assume your capital is resting securely behind a strong brand name, the internal metrics might be quietly deteriorating.
The company might be taking on subtle increases in debt to mask declining operating margins.
Or their core product line is facing obsolescence from some new tech.
Right. The interest coverage, the actual ratio of operating earnings available to pay their debt, might be steadily shrinking quarter after quarter.
Management could be doing aggressive debt-funded acquisitions that change the whole risk profile of the enterprise.
So the permanence investors are seeking, it's not an intrinsic property of the security itself. It is simply a psychological projection.
Wow. Yeah, supervision is the methodical process of testing that psychological hope against empirical reality.
Because when investors abandon supervision and rely entirely on historical reputation, they leave themselves intensely vulnerable to structural changes they just refuse to monitor.
And that vulnerability is massively compounded when investors try to squeeze just a marginal amount of extra performance out of these supposedly safe assets.
Which brings us directly to the brutal mathematics of reaching for yield.
It really does require a complete reframing of how capital allocators evaluate income generation.
Because the standard industry approach just conditions you to look at a menu of fixed income options and immediately ask, well, what is the yield?
But focusing purely on the nominal percentage completely ignores the friction costs of reality.
Right. The sophisticated allocator has to ask a totally different question.
Which is,
what is the actual realized yield after properly accounting for the required analytical effort, the psychological anxiety, the probability of mistakes, and the statistical potential for permanent loss of principal?
So let's illustrate the exact mechanics of this trap. We'll walk through a highly specific mathematical scenario that plays out in the markets every single day.
Okay, let's do it.
Let's assume you're evaluating where to place your capital. You have the option to buy a truly safe medium, right? A government bond or a fully insured bank deposit.
Where absolute safety of principal is structurally guaranteed.
Exactly. And in this scenario, let's say that risk-free medium offers a yield of 2.5%.
So you get 2.5% with zero anxiety and zero need for ongoing business analysis.
But inevitably, you're presented with an alternative. A broker or an ad highlights a conservative corporate investment, say a high-grade corporate bond.
Okay.
And this alternative offers a stated yield of 3.5%.
So you look at the two options and see an extra yield of exactly 1 percentage point.
Right. And if we apply this to a $100,000 portfolio, that 1% difference is $1,000 of additional income per year.
And to the human brain, an extra $1,000 feels like an intelligent optimization.
It feels like you're leaving money on the table if you don't take it.
It does, but the initial framing makes it look like simple efficiency. We have to examine the hidden structural costs attached to that $1,000.
Because to earn that extra 1%, you've crossed a boundary.
You absolutely have. You've moved from a risk-free environment into an environment that demands active credit judgment.
You have to do due diligence on the corporate issuer now.
You have to periodically review the financial statements to ensure the credit quality hasn't decayed.
You have to monitor the macro environment for industry impacts.
And, maybe most importantly, you must possess the emotional discipline to sell the bond and reallocate the capital if your analysis reveals structural weakness.
That is a massive amount of time and cognitive energy for $1,000.
But the true danger is revealed in the wipeout scenario.
Right. What happens if this conservative corporate investment encounters severe distress?
And you suffer a 10% permanent impairment of your principal.
The math here is sobering. A 10% permanent loss on a $100,000 allocation is a $10,000 absolute reduction in capital.
You took on all that complex burden of credit analysis and ongoing supervision purely to capture an extra $1,000 a year.
And when the 10% impairment hits, that single $10,000 loss instantly vaporizes 10 entire years of the extra yield you worked so hard to collect.
10 years of incremental income optimization, completely erased by a single, relatively modern misjudgment in credit quality.
It's painful to even think about. It proves that reaching for marginal yield in fixed value instruments is frequently an atrocious structural bargain.
Because when the incremental income is small, like just 1% here, but the potential for principal impairment is absolute, the mathematical asymmetry is working entirely against you.
You are risking a permanent reduction in your foundational capital base in exchange for a temporary marginal increase in cash flow.
And this mechanism of risk transfer is a constant feature of financial markets. The terminology just constantly evolves to sound sophisticated and reassuring.
Right, they don't just call it corporate bonds anymore.
No, the market invents categories like enhanced yield, private credit, structured income solutions, or senior secured floating rate strategies.
The marketing architecture around these products is brilliant. It's designed to obscure the fundamental risk transfer.
The labels project institutional safety while offering yields slightly above the risk-free rate.
But the underlying temptation and the mathematical trap is identical to what existed a century ago.
The core mechanism you have to understand is that a high stated yield is the market's pricing mechanism for danger.
Wow. Yield is never, under any circumstances, a structural substitute for safety.
Never. If an instrument is yielding more than the prevailing risk-free rate, it is because the market recognizes a probability of default, a lack of liquidity, or structural subordination in a bankruptcy.
Someone is transferring their risk to your balance sheet, and they are compensating you with a fraction of a percent to accept it.
And as an allocator, you have to rigorously determine if that fractional compensation adequately covers the statistical probability of a 10-year wipeout scenario.
Recognizing that chasing yield is a mathematical hazard forces you to confront a practical reality. Where exactly does the capital go?
Right. What are the actual options?
If you dissect the entire universe of investment opportunities, there are essentially three distinct structural paths for capital allocation.
Let's walk through it.
The first path is the truly safe medium. This encompasses government bonds, high-quality municipal securities, and insured savings deposits.
The defining feature here is the absolute preservation of principal value, entirely independent of your analytical capabilities.
Path 1 is the baseline of capital preservation.
And for a significant portion of moderate investors, especially those whose primary professions demand all their cognitive bandwidth, accepting the lower nominal yield of path, 1 is a profoundly rational, structural decision.
Even though the financial services industry constantly tries to shame investors into moving further out on the risk curve.
Oh, totally. They suggest holding risk-free assets is somehow a failure to optimize.
The pressure to put your money to work is unrelenting. But actively choosing the truly safe medium is not anti-investing.
It is the ultimate expression of pro-suitability.
The optimal capital allocation decision is rarely the most mathematically complex. It's the one that aligns perfectly with your actual psychological reality and your genuine willingness to perform ongoing maintenance.
If you know definitively that you have no intention of continually inspecting the structural integrity of a corporate balance sheet, the only logical action is to remain on the solid ground of government-backed safety.
That self-awareness is a massive competitive advantage.
It really is.
Moving to the second structural option, we encounter path 2, speculation.
Speculation, in its purest mechanical definition, is the conscious acceptance of principal risk in the active pursuit of outsized profit.
Now, this requires careful unpacking. Isn't accepting risk for profit the whole point of markets?
In a theoretical vacuum, yes. The risk-reward trade-off is the foundation of capital markets.
But practically speaking,
Practically, for the average individual deploying personal savings, it is exceptionally hazardous.
why is it so dangerous for the individual?
Because when an individual attempts to speculate, they enter an arena where they are structurally disadvantaged on almost every front.
Right. They're battling their own inherent psychological biases,
They are contending with the powerful gravity of crowd psychology.
paying frictional trading costs that compound against them.
And most critically, they are competing directly against institutional insiders, specialized analysts, and algorithmic systems that possess vastly superior informational architecture.
It's a totally asymmetrical battlefield.
Exactly. Speculative activity is marketed as financial freedom, the ability for anyone to discover the next massive tech winner.
But the structural reality is that for the untrained participant, speculation usually functions as tuition paid to the market ecosystem.
Your capital is slowly or rapidly transferred to specialized participants, and you learn a severe lesson about market mechanics.
And the most destructive phase of this dynamic isn't when an investor knowingly buys a highly volatile tech startup.
No, the absolute apex of danger occurs when speculation actively disguises itself.
That is so important. The most devastating capital impairments happen when a fundamentally speculative instrument wears the costume of safety.
Like when the financial industry engineers a product, say, a fragile preferred stock issued by a heavily indebted corporation, and markets it entirely on the basis of its conservative dividend yield.
Or they package a complex, opaque derivative structure and sell it as a stable cash flow generator.
Let's examine the mechanics of that fragile preferred stock because it perfectly illustrates disguised speculation.
Okay, lay it out.
A preferred stock sits below debt in the capital structure, meaning in a bankruptcy, bondholders are paid first. Preferred equity holders only get what's left, which is often nothing.
Plus, unlike bond interest, a company isn't legally obligated to pay the preferred dividend if they encounter financial distress.
Right, they can just suspend the payment without triggering a default.
So you buy this instrument thinking you acquired a safe, bond-like asset because it pays a fixed percentage.
But in reality, you have zero legal protection if the company's operating earnings falter.
The external form communicates safe, predictable income, but the internal mechanics represent pure speculation on the continuous perfection of the company's operating environment.
And if you don't have the analytical framework to recognize that structural subordination, you are completely blind to the speculation you just undertook.
You are in the maximum danger zone because your risk exposure is totally disconnected from your risk awareness.
Which leads us to path 3, the intermediate field.
Right. Pure security analysis.
This is where you rigorously seek out situations that combine genuine structural investment merit with a statistically probable profit opportunity.
Finding mispriced securities, distressed situations where asset value exceeds the market quotation, or fundamentally sound enterprises trading at a massive discount.
This intermediate field is the operational sweet spot for the highly trained allocator.
But there's a massive flashing warning sign here for the untrained investor.
Yes, the critical error untrained investors make is confusing an attractive statistical display with actual durable business safety.
A statistical display being a superficial financial metric, like running a screen and finding a company trading at a remarkably low price-to-earnings multiple.
Or identifying a stock with a massive double-digit dividend yield.
You look at the low multiple or high yield and immediately conclude you found a value investment.
But the mechanics of business reality dictate that a depressed share price does not automatically constitute a margin of safety.
And a high nominal yield is not inherently a bargain.
If you can't forensically examine the balance sheet or accurately model cash flow sustainability, those statistical displays are meaningless.
Buying a company just because it has a low PE multiple without understanding its core product is facing rapid technological extinction is not value investing.
No, it's just acquiring a dying enterprise as its valuation compresses towards zero.
So if you deliberately choose to allocate capital into the corporate fixed value space or this intermediate equity field, you are signing a binding operational contract.
And that contract demands a commitment to ongoing methodical supervision.
But supervision is merely observational. What exactly is the mechanism of action when your supervision reveals that the structural integrity of your holding is decaying?
This introduces the required operational discipline of switching and the psychological hazard of becoming an accidental speculator.
Let's establish the operational definition of switching first.
Switching is the decisive clinical act of selling a holding whose fundamental safety has become questionable for the explicit purpose of reallocating that exact capital into a demonstrably stronger, more secure instrument.
It's the mechanism of portfolio repair. You see the structural cushion deteriorating, interest coverage drops, debt increases, and you decisively move the capital to a safer harbor.
But the psychological friction occurs because this action frequently requires you to accept a moderate realized loss.
The asset's price is likely declined, and executing the switch means permanently locking in that negative number on your brokerage statement.
And no one enjoys crystallizing a loss. It violates our desire to be correct.
But you have to completely detach from the concept of being right and adopt a pure maintenance mindset.
The analogy of real estate ownership is structurally identical here.
If you own an apartment building and the roof begins to leak, you don't view the cost of replacing the roof as a failure of your real estate acumen.
Exactly. You view it as the unavoidable, mandatory cost of maintenance required to preserve the structural integrity and cash-generating capacity of the asset.
Taking a moderate, deliberate loss during a necessary switch is not a failure. It is simply the frictional cost of maintenance.
The maintenance analogy is powerful because it removes the ego. You aren't failing, you're actively maintaining the structure.
However, executing this maintenance has become vastly more difficult due to changes in modern market mechanics.
Historically, high-grade securities exhibited this phenomenon known as price inertia.
Right. The internal metrics of a corporate bond could begin a systematic decay bleeding cash, struggling to refinance, but the quoted market price would remain artificially elevated for an extended period.
Investors relied heavily on historical reputation, and information flow was significantly slower. This gave a massive advantage to the diligent analyst.
It gave them the luxury of time. An alert investor could identify the decay in the financial statements and quietly execute a switch, selling at a premium before the broader market consensus recognized the danger.
But the mechanics of the modern market have entirely eliminated that inertia. Markets today reprice risk with violent, instantaneous precision.
The moment deterioration becomes public, the market price adjusts violently downward in milliseconds.
The luxury of leisurely identifying a problem and selling at yesterday's price simply does not exist anymore.
By the time the deterioration is obvious to the casual observer, the capital impairment has already occurred.
And this instantaneous repricing is the exact catalyst that triggers the behavioral trap of the accidental speculator.
This is such a critical behavioral trap. It's a step-by-step cascade where a conservative investor is transformed into a pure gambler without ever making a conscious decision to change strategies.
Let's trace the mechanics of that.
Step 1. The investor deploys capital into a security purely for stable income and principal safety. Their intent is entirely conservative.
Step 2 is the failure of process. The investor neglects to perform rigorous periodic supervision. They rely on the initial safety and let the asset sit unmonitored.
Step 3 is the structural decay. The business encounters severe headwinds, earnings compress, and the market violently marks down the price before the investor even knows there's a problem.
So the investor finally reviews their portfolio, expecting stable value, and instead stares at a 30 or 40% capital impairment on a supposedly safe asset.
Step 4 is the psychological reaction to that pain. Facing a substantial loss, the investor's ego intervenes. They refuse to execute a switch.
They rationalize it. They say, well, the market is acting irrationally, the algorithm's overreacted. I will simply hold on to the position until the price eventually recovers to my initial cost basis.
And that rationalization is the exact moment the tragedy occurs.
The initial intention was safe income. But the objective facts have fundamentally changed. The safety is gone.
By refusing to acknowledge the new reality and holding a compromised asset solely in the hope of a price recovery, They are no longer an investor holding a safe instrument.
They are actively betting on a future price movement to bail out their initial error.
By simply doing nothing, they mutated from a conservative allocator into a pure speculator, praying for a turnaround.
They allowed the market to back them into a corner where the only options are a massive loss or blind speculation.
How do you construct a portfolio so you are never faced with that binary choice?
The structural answer, the ultimate defense mechanism, is the initial cushion, the margin of safety.
The concept of the margin of safety must be applied with extreme rigor here.
The classic Graham and Dodd framework demands that you insist on an exceptional margin of safety at the moment of purchase, entirely rejecting one that is merely adequate.
The difference between exceptional and adequate dictates whether you survive a crisis or become an accidental speculator.
Let's examine the mechanics of this using exact numerical parameters, specifically focusing on interest coverage.
Real quick, define interest coverage for context.
It's the ratio that demonstrates how many times a company's current operating earnings can cover their mandatory interest payments on their debt. It's the literal cushion between profitability and default.
Okay, got it.
So let's construct a scenario. You acquire a corporate bond, and at purchase, the company's operating earnings are 20 times their required interest payments.
They have a massive, exceptional structural cushion.
Right. Now, we introduce a severe macroeconomic shock. A recession hits. The company's operating earnings collapse. The coverage ratio plummets from 20 times all the way down to 4 times.
A drop from 20x to 4x represents a catastrophic decline in underlying business performance. The profitability has essentially been decimated.
It is a massive shock. However, look at the mechanics of the outcome. Even after that catastrophic decline, the company is still generating 4 times the cash required to service its debt.
As a bondholder, your principal is not in immediate jeopardy of default.
Exactly. The massive initial cushion absorbed the entirety of the shock. You are granted the most valuable asset in a crisis time.
You have the luxury to calmly analyze the new reality, assess if the decay is permanent or temporary, and systematically decide if you want to switch to a stronger security entirely without panic.
Now, contrast that with a merely adequate cushion. You acquire a different bond. The company is profitable, but the interest coverage is only 3 times.
It passes a minimal standard, but the cushion is incredibly thin.
The mechanics of failure are vastly accelerated here. The company encounters a mild headwind, input costs rise slightly, earnings compress marginally.
Instantly, that 3x coverage drops to 1.5x or even 1x.
The business is suddenly generating exactly enough cash to pay the interest with 0 room for error.
Your investment has been instantly, violently thrust into the danger zone. You have no time to evaluate, the market price has collapsed, and you face the accidental speculator's dilemma.
Take the massive loss, or hold and pray they don't default next quarter.
Think of it like the structural engineering of a physical bridge.
Yes, the bridge analogy is perfect here.
An engineer designing a major suspension bridge doesn't calculate the exact weight of normal Tuesday afternoon commuter traffic and build the bridge to support only that specific load.
Right, they calculate the normal load, and then they engineer the steel and concrete to support 5 or 10 times that weight.
They build in a massive structural reserve because they understand the bridge isn't designed to function perfectly on a sunny day with light traffic.
It's engineered specifically so that when the environment introduces a completely abnormal, unpredictable stressor, a Category 5 hurricane, or a massive gridlock of fully loaded commercial freight trucks, the structural integrity holds.
The bridge does not immediately collapse into the river. The margin of safety is your portfolio's structural reserve.
It's the excess capacity explicitly designed to absorb macroeconomic shocks, management errors, and technological disruptions you absolutely cannot predict.
But we must introduce a vital qualitative caveat here. The numerical calculation of a margin of safety is completely invalid if the underlying economic reality of the business is fundamentally doomed.
This is where pure quantitative analysis fails.
A 20x interest coverage ratio is a mathematically beautiful number. But if that ratio belongs to a company whose singular product has just been rendered permanently obsolete by a new technology, that 20x ratio is a mirage.
The historical earnings that generated that ratio are going to 0, and the margin of safety will evaporate instantly.
The quantitative numbers dictate the size of the structural cushion, but the qualitative business analysis dictates the durability of that cushion.
Exactly. A 20x coverage ratio generated by a highly regulated utility company providing essential baseline power is a structurally durable cushion.
But a 20x ratio generated by a highly cyclical commoditized mining operation right at the absolute peak of a global infrastructure boom.
That is a highly fragile cushion. You have to relentlessly analyze the physical reality of the business operations, not just the spreadsheet output.
So, having established the absolute necessity of the margin of safety and the requirement to inspect the structural integrity, we need to define the exact mechanics of that inspection.
What are the specific parameters you must review?
The source material provides a rigorous, modern framework for supervision, detailing a 7-point fixed income checklist.
This framework forces you to look past the market, quote, and directly at the physical reality of the enterprise.
Let's walk through the points.
The first parameter is coverage. You must forensically examine whether mandatory interest payments or preferred dividend obligations are still comfortably overwhelmed by operating cash flow.
Have operating margins compressed? Is the fundamental cushion shrinking?
The second parameter examines the architecture of the balance sheet. This isn't just looking at the total debt number, it's analyzing the structure of that debt.
Has aggregate leverage increased? And importantly, what is the maturity schedule?
Right. Is the company facing a wall of debt coming due in the next 24 months that they will be forced to refinance in a hostile, higher interest rate environment?
The third point addresses business stability. This requires a qualitative assessment of the revenue architecture.
Are cash flows structurally resilient against inflation or economic slowdowns?
Or is the enterprise suddenly facing predatory pricing from a heavily capitalized competitor?
You are looking for any fundamental shift that threatens the stability of the earning power.
The fourth parameter is perhaps the most critical in modern markets: capital allocation. This evaluates the actions of the executive management team.
What are they doing with the free cash flow?
The tension here is bondholders want cash retained to build the balance sheet, while equity holders want cash distributed.
Are executives acting as responsible stewards or aggressively issuing new debt to fund massive stock buyback programs?
Buying back stock at all-time highs using borrowed money fundamentally weakens the credit profile to artificially boost earnings per share.
The fifth parameter is liquidity, the ultimate defense against an immediate crisis.
If credit markets completely freeze tomorrow, does the enterprise possess sufficient actual cash on the balance sheet?
Do they have massive, undrawn, revolving credit facilities? Can they survive a localized stress event without defaulting on immediate obligations?
The sixth point demands a clear understanding of your ranking in the capital structure. You must know precisely who has a legal right to be paid before you do.
Has the company issued new, senior secured debt that now sits above your unsecured bonds?
Are there unfunded pension liabilities or complex lease obligations that could drain the asset base in a restructuring scenario?
You must constantly verify your exact position in the line for recovery.
And the final parameter is the relationship between price versus intrinsic risk. Has the market's pricing mechanism accurately digested any changes in the underlying reality?
If your supervision reveals fundamental safety has deteriorated, but the market is still pricing it at a premium as if it were perfectly safe, that is a clear signal to execute a switch.
Conversely, if the business remains robust, but the market irrationally compressed the price due to forced liquidation or macro panic, selling would be an unforced error.
This 7-point architecture is phenomenally rigorous for fixed value instruments. But the mechanics translate directly to equity evaluation as well.
The terminology shifts, but the objective remains identifying the durability of the structural cushion.
For an equity allocator, instead of solely monitoring interest coverage, the primary metric becomes return on invested capital, or ROIC.
ROIC is the fundamental engine of equity compounding. It measures how efficiently management generates cash from the capital retained in the business.
You are actively supervising the durability of the enterprise's economic moat.
You are analyzing the conversion rate of net income into actual free cash flow.
And critically, you are monitoring for structural dilution. If management is constantly issuing new shares to fund executive compensation, they are systematically shrinking your proportional ownership.
Implementing this level of rigorous evaluation brings us to a profound operational distinction.
Yes, the distinction between supervision and surveillance.
If an investor attempts to run this comprehensive 7-point diagnostic on every position every single day, the psychological friction will destroy them.
The failure to distinguish between supervision and surveillance is why so many investors experience intense emotional burnout.
Surveillance is the hyperactive monitoring of market quotations.
It's opening a brokerage app multiple times a day to see if the price is flashing green or red.
It's entirely focused on the external opinions of the market, and it generates nothing but compounding anxiety.
Supervision, conversely, is the methodical, periodic evaluation of internal business value.
It ignores the daily price quote and asks, does the fundamental earning power and structural integrity remain intact?
Supervision builds objective judgment. Surveillance destroys it.
Surveillance asks, what does the crowd think today? Supervision asks, what is the physical reality of the business doing?
By focusing on the business reality, you can operate on a much calmer frequency. You only need to run the diagnostic periodically.
But this calm, methodical framework is designed for relatively normal operating environments.
Right. What happens when the entire macroeconomic structure fractures?
The ultimate test of discipline occurs when the market enters a severe depression, a liquidity panic, or a massive structural dislocation.
When a true systemic panic materializes, the paramount requirement is extreme operational humility and highly realistic expectations.
You cannot expect to escape structural price shrinkage in a severe collapse.
Almost every asset class will experience valuation compression. Your portfolio will display significant negative volatility.
The objective during a panic is not to maintain daily emotional comfort. That is structurally impossible.
The singular objective is rational action and the survival of your compounding machine.
The first directive during a systemic crisis is to actively resist the stampede. The psychological pressure to liquidate everything will be overwhelming.
And that is exactly when the prior work of supervision proves its absolute value.
If you maintained your discipline, insisted on an exceptional margin of safety, and your periodic supervision confirms the core enterprise remains viable,
then succumbing to the panic and executing forced selling at severely depressed prices is the most mathematically destructive action you can take.
you are permanently destroying capital because of a temporary macroeconomic distortion.
We can categorize the investor response to a crisis into 3 distinct operational behaviors: panic, paralysis, and active judgment.
Panic is the visceral, unthinking reaction. Liquidate all holdings immediately, regardless of intrinsic value, seek the absolute safety of cash, and lock in massive permanent losses.
Paralysis is the inverse reaction. The investor is so overwhelmed by the decline that they completely disengage. They freeze, refuse to look at statements, abandon supervision, and hope the storm passes.
Both panic and paralysis are operational failures.
The correct posture is active judgment, which is the purest application of supervision under extreme stress.
Active judgment dictates that you clinically review the physical facts of your holdings, entirely divorcing your analysis from the terrifying price action on the screen.
You refuse to liquidate your structurally sound assets. However, you recognize that a severe macroeconomic dislocation creates massive relative pricing inefficiencies.
A panic is the ultimate environment for portfolio repair.
It is the single greatest opportunity an allocator will ever encounter.
During a liquidity event, the market indiscriminately marks down the price of everything.
This creates a highly unusual environment where you can execute a switch out of a fundamentally weaker holding and redeploy that capital into an incredibly strong, durable, high-quality asset trading at a massive discount to its intrinsic value.
You use the chaos to radically upgrade the structural quality of your capital base.
But executing that level of clinical judgment while the broader ecosystem is melting down is exceptionally difficult in isolation.
The cognitive load is immense. Recognizing this, most investors attempt to outsource this responsibility. They seek professional counsel.
But bringing an advisor into the process does not eliminate the requirement for supervision. It merely shifts the focus. You must now supervise the advice chain itself.
The decision to utilize professional advice requires rigorous structural analysis.
Operating as your own sole counsel, isolated from external perspectives, carries severe risks of confirmation bias. But blindly accepting the dictates of the financial industry is equally catastrophic.
You have to evaluate the advice ecosystem objectively, understanding the exact incentive structures embedded within each source of counsel. Let's dissect the 5 primary sources of advice.
Okay, the first entity is the commercial bank.
Right.
The commercial banking model is generally structured to act as a highly conservative guardrail, which is useful for smaller allocators.
Their primary relationship with the client is holding deposits and issuing loans.
So they have a vested interest in ensuring you do not annihilate your capital in speculative ventures. They guide you towards stability.
However, they fundamentally lack the deep analytical architecture required to perform rigorous security analysis or manage complex custom allocations.
The second category encompasses underwriting and investment banks.
When we look at Wall Street institutions, the critical question is whether their advice is inherently compromised by their business model. Are they dishonest?
It's not a question of overt dishonesty, it's a question of structural gravity.
Right.
An investment bank's primary function is underwriting new securities and distributing them to the public markets.
By definition, they possess massive inventories of securities sitting on their balance sheets that they must sell.
And whenever an entity is tasked with moving inventory, their institutional self-interest will inevitably exert pressure on their impartial judgment.
When you engage with their advisory arm, you are interacting with a highly sophisticated distribution network, not purely independent counsel.
The third major source is the traditional brokerage firm.
The brokerage architecture is distinctly different. Brokers generally do not hold the inventory they recommend.
However, their compensation model is historically driven by transaction velocity. They earn commissions or spreads when you buy and sell.
They require activity to generate revenue.
Precisely. Their economic survival depends on capital in motion.
Because of this necessity, the brokerage environment naturally generates an atmosphere of continuous market commentary.
They amplify macroeconomic noise, highlight short-term price volatility, and constantly present new opportunities.
The psychological effect is profound. In a brokerage ecosystem, a structurally sound, thoroughly researched, inactive portfolio feels inherently boring.
Or neglected. And this engineered boredom is highly effective at inducing investors to abandon supervision and engage in unnecessary, friction-heavy trading.
The fourth model is the fee-based independent counsel.
Structurally, this model aligns most closely with impartiality. They don't hold inventory to distribute, and their revenue isn't tethered to transaction volume.
They are compensated via a flat retainer or a percentage of total assets managed. The advice is theoretically pure.
However, the allocator must rigorously analyze the mathematical drag this model imposes on their compounding engine.
Let's run the exact mechanics of the advisory fee, because the math is frequently misunderstood.
Let's assume an allocator hires a fee-based counsel who charges an annual management fee of 0.5% on the total asset base.
0.5% sounds entirely negligible. It feels like a rounding error.
It sounds minimal until you apply it to the actual yield generation of a fixed value portfolio.
Okay, let's say the counsel constructs a portfolio of corporate bonds generating an aggregate yield of 3.5%.
The advisor deducts their 0.5% fee. The mathematics reveal that the fee is actively consuming 14.3% of the total income generated by the portfolio.
Wow. You are surrendering roughly 1/7 of your entire cash flow simply to maintain the advisory relationship.
Surrendering 14.3% of your gross income every single year is a massive structural impediment to long-term compounding.
You have to justify that expenditure with ruthless objectivity.
It's only mathematically justifiable if the counsel provides rigorous, fundamental security analysis that you cannot perform yourself.
It's only justified if they implement sophisticated tax-aware structuring, and crucially, if they enforce strict behavioral risk control during market panics.
If the counsel attempts to justify their extraction by claiming they possess proprietary models to perfectly time short-term bond market fluctuations,
Or if they claim they can forecast the exact onset of the next recession.
you must view them with extreme skepticism. You are paying for structural discipline, not macroeconomic prophecy.
Ultimately, the allocator cannot abdicate their fundamental responsibility. You must rigorously supervise the supervisor.
You have to relentlessly interrogate the advisor's incentive structures, analytical frameworks, and operational protocols.
To operationalize everything we've discussed, the allocator requires a highly practical, repeatable toolkit.
The theoretical frameworks must be distilled into an actionable process. We can consolidate the mechanics into a precise 5-question review framework.
When you sit down to review the structural integrity of a holding, you must sequentially answer these 5 specific questions.
Question 1 establishes the baseline. What was the original specific structural reason for allocating capital to this asset?
If you cannot precisely articulate the fundamental thesis of the initial purchase, you have absolutely no foundation upon which to build your supervision.
Question 2. Forces predictive discipline. What specific, measurable facts would have to materialize to prove that the original reason is actively weakening?
You must define the metrics of failure in advance. Will you monitor for a specific compression in operating margins, a defined increase in the debt-to-equity ratio?
A loss of market share to a specific competitor. You must identify the tripwires before the environment becomes chaotic.
Question 3 quantifies the structural reserve. What was the exact mathematical size of the margin of safety when the asset was purchased, and precisely how much of that original cushion remains intact today?
You are actively calculating the rate of decay. Did the interest coverage ratio compress from an exceptional 20 times down to an adequate 5 times?
You must continuously know exactly how close the enterprise is operating to the edge of the cliff.
Question 4 is designed to shatter behavioral biases, specifically the anchoring effect. If my portfolio was entirely in cash at this exact moment, would I actively choose to deploy new capital to purchase this specific asset at today's market price, given the fundamental facts as they exist right now?
This is the most psychologically demanding question in the framework.
It really is. The human brain naturally anchors to the historical purchase price and historical narrative.
By forcing yourself to evaluate the asset as a completely new transaction, you bypass the emotional attachment.
If the objective answer is that you would absolutely not buy the asset today, you must ruthlessly question why you're allowing it to remain in the portfolio.
And finally, question 5 dictates the operational mechanics of the switch. Is there a demonstrably superior alternative available in the market after rigorously calculating all frictional costs, including capital gains taxes and transaction fees?
Because switching is not an exercise in alleviating minor boredom or reacting to slight discomfort, you do not churn the portfolio.
You execute a switch only when the mathematics conclusively prove that moving the capital net of all taxes and fees places the portfolio in a materially stronger structural position.
This 5-question architecture is incredibly robust. However, applying it raises a theoretical conflict for many equity allocators, particularly those who model their approach on Warren Buffett.
Right. Buffett is famous for stating that his favorite holding period is forever.
So does the core thesis of this framework, the assertion that there are absolutely no permanent investments and everything requires supervision, fundamentally contradict the Buffett model.
It's a critical distinction, and the answer is definitively no. There is zero structural conflict.
The confusion arises from conflating an operational intention with an objective fact.
Buffett's stated intention is to hold exceptional assets indefinitely. However, his holding is never, ever blind.
The intention of indefinite ownership does not guarantee the fact of permanent safety.
Exactly. Buffett is continuously, ruthlessly running his version of the 5-question framework.
He is constantly supervising the durability of the enterprise's economic moat. He is forensically evaluating the executive team's capital allocation decisions.
If the fundamental facts permanently degrade, if the competitive advantage is breached by technological change, or management begins destroying value through reckless acquisitions, Buffett will execute a switch and liquidate the position.
Long-term ownership is the optimal outcome, but it is entirely dependent on continuous, rigorous supervision confirming the asset still deserves the capital.
Which brings us to the operational rhythm. What is the optimal cadence for deploying this 5-question framework?
How often should you run these diagnostics to maintain structural integrity without crossing the line into the anxiety of surveillance?
The cadence must be deliberate and calm. For the vast majority of allocators, executing a formal, comprehensive review of the portfolio once or twice a year is entirely sufficient.
The exception to this annual schedule is the occurrence of a major structural catalyst.
If a holding announces a massive debt-funded acquisition, or rating agencies issue a severe credit downgrade, or the core executive team abruptly resigns,
that event triggers an immediate, out-of-cycle deployment of the review framework.
And a crucial component of this review process is that it must be documented. The answers to the 5 questions must be explicitly written down.
The discipline of writing is non-negotiable. The human brain is a phenomenal engine for rationalization and self-deception.
If you merely think through the questions, you will allow vague, optimistic feelings to masquerade as rigorous analysis.
Writing down the fundamental thesis, the exact metrics of the margin of safety, and the defined parameters of failure forces absolute objective clarity and prevents narrative drift.
That requirement for objective clarity leads directly into the psychological barrier that prevents most allocators from executing necessary portfolio maintenance.
We touched on it earlier regarding the moderate loss, but we need to define the exact psychological mechanism. Price embarrassment.
Price embarrassment is the ultimate psychological adversary of rational capital allocation. It is the ego's defense mechanism against acknowledging an analytical error.
How does it physically manifest in an allocator's behavior?
When you perform supervision and discover the fundamental thesis is broken, the asset's market price has usually already declined significantly.
Confronting that red number on the brokerage statement generates intense psychological discomfort.
Executing the switch and crystallizing the loss feels like a public admission of intellectual failure. It is deeply embarrassing.
To avoid that emotional pain, the ego seizes control. You freeze.
You refuse to reallocate the capital to a mathematically superior opportunity, and instead you hold the decaying asset entirely in the hope of a miraculous price recovery that will spare you the embarrassment of being wrong.
You subordinate the mathematical survival of your portfolio to the protection of your own ego.
Precisely. The entire operational design of the 5-question review framework, specifically the mandate to perform it early and objectively, is to detect structural deterioration in its infancy before the market price completely collapses.
If you identify the decay early, the required switch only generates a moderate loss.
Psychologically, it is vastly easier to accept a small, frictional loss as a cost of maintenance than it is to overcome the devastating price embarrassment of a massive capital impairment.
We have established the theoretical frameworks, the psychological defenses, and the operational toolkit. But you must confront one final reality of the physical markets: the supply problem.
The theoretical mandate to demand exceptional margins of safety encounters severe friction when it collides with actual market environments.
The supply problem is where theoretical discipline is forged into actual operational fortitude.
The mathematics of demanding a 20 times interest coverage ratio or a pristine balance sheet are incredibly difficult to execute during periods of macroeconomic euphoria.
Because during a massive economic boom, everyone around you is generating enormous paper wealth by aggressively buying low-quality, highly speculative assets.
Exactly. When the macro environment is roaring and liquidity is abundant, the supply of truly exceptional, high-yielding, structurally safe assets completely evaporates.
The market bids up the price of everything, compressing yields and eliminating the margin of safety across the entire ecosystem.
It is precisely in this environment that human nature exerts immense pressure on you to lower your operational standards.
The psychological pressure to participate, to deploy the capital, is overwhelming.
You begin to rationalize the degradation of your own framework. You tell yourself, well, historically I required 20 times coverage, but the central bank stabilized the economy, so perhaps 3 times coverage is perfectly acceptable in this new paradigm.
You systematically dismantle your own defenses simply to relieve the pressure of holding cash.
The most brutal, unforgiving lesson in capital allocation is that you must be absolutely ruthless in enforcing your discipline, precisely when the market environment makes that discipline feel entirely unnecessary.
When the broader market consensus is openly mocking your caution and demanding you lower your standards to participate in the boom, that is the exact moment the structural integrity of your margin of safety is most critical.
Because that period of peak euphoria is the exact moment the structural load on the bridge is about to be violently tested by reality.
The market cycle always turns. The liquidity always contracts. And the margins of safety are always tested.
The allocator who maintained their discipline during the boom is the only one who possesses the structural resilience to survive the bust.
As we conclude this deep dive into the architecture of supervision, let us distill the absolute core structural principles of this analysis.
If you extract nothing else from this framework, permanently internalize the operating realities. Safe at the moment of purchase does not guarantee safety in perpetuity.
A long-term holding period does not equate to an unattended holding period.
A high stated yield is not a structural protection against principal impairment. It is a warning of risk transfer.
And a historical reputation is absolutely no substitute for rigorous, continuous fundamental analysis.
I want to leave you with a final structural concept to evaluate. We traditionally define capital allocation as the initial analytical act of deciding where to deploy your capital.
But the reality of market mechanics dictates that true capital allocation is a continuous active process.
It is the operational discipline of actively deciding every single day where your capital still fundamentally deserves to remain deployed.
So apply this diagnostic to your own architecture. If you were forced to liquidate your entire portfolio to cash today, and you had to individually rehire every single asset based entirely on their fundamental business facts as they exist this morning.
How many of your current holdings would permanently lose their jobs?
That is the ultimate diagnostic question. It completely annihilates the passivity of the permanent investment dream.
It transforms you from a passive collector of securities into a ruthless, active steward of capital.
Because the goal is not to build historical monuments to past decisions. The objective is to build structurally resilient bridges capable of surviving the inevitable macroeconomic storms.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free. And please utilize the comment section to engage with the material. Leave your questions and, most importantly, suggest the next fundamental investing concept you want us to structurally deconstruct. Do you want a deep dive into the mechanics of owner earnings, dividend policy, stock buybacks, the intricacies of capital structure, or the specific mathematics of return on invested capital? Let us know.
Until next time, ensure your analytical process remains calm, your structural standards remain exceptionally high, and your capital is allocated with relentless care.